Capital gains tax versus income tax. What is the difference? Why is there a difference? That's what I want to talk about here in this video. So let's just get right to it. For some reason, you were watching this video because I'm assuming maybe it's tax time or maybe you're just curious, but a very valid question. Okay, yeah, why is there a difference? Why are these two taxes separated out? And why are they structured the way that they are? And at the core, the reason why they're structured the way they are is because of one word, and that word is risk. This is, like I said, the pillar of their reason for the separation. And I can't believe I'm saying this, but the government, hey, you know what? They're thinking things through in this regard, and I'm glad to know that they're acknowledging the risk that is out there, and they're factoring that into the tax rate system. Again, it almost feels dirty to give the government, but hey, you know what? You got to give credit where credit's due. So let's go through the flow of cash, if you will, in terms of money. So we have Bob, and Bob's going to go out there and he's going to go to his job. And at his job, well, now it's a legitimate job, right? So it's not like he's taking on any sort of, sketchiness. He's not like, selling crack to the kids at the playground or anything like that. He's just a legitimate job. He's going to go and get money, right? So he drives to work. He works the job. He gets money. That would be known as income. Now, at this point, because he has income, what's going to happen here? Well, you're saying, well, Clay, the title of this video says there's an income tax. Exactly. So at this point, this money here is being taxed. So it has been taxed right there because, again, it is income. Nothing fancy there, but that is the income tax where you are working a job and then you're getting paid. But let's circle back to the risk. Is there any risk here? Now, you could argue, well, yes, there's risk that the company might just all of a sudden say, well, we're not going to pay you. Well, then that's why employment contracts exist, because Bob can then go and sue and, get money. He can maybe get a whole lot more money if they're all of a sudden the company just says, no, we're just kidding. We're not going to pay you that. So yes, I do understand. Well, technically, Clay, that would be a risk. And you're right. But can we agree that in the vast majority of times, if you go to a job, you have extremely low risk that you're going to get money. You're going to get paid. So essentially, there is no risk at all if you're going to go to a job to make your money. Hence the income tax, which is why the income tax, and I'm not going to give these rates, I'm just making up because they're changing over time, but just to illustrate a broader idea here. So this tax, let's just call it, 25%. But now we have a secondary scenario because Bob is gone. He's done this. He's made money. He's paid the income tax. And let's just say the next year, Bob's like, well, I've always read that investing is good. You don't want to just spend money. You want to save it. You want to invest it. So Bob goes out there and he invests. Now, what money is he investing with? Well, he's investing with this money right here, right? I'm going to make that blue because remember, that money has already been taxed once, okay? So it's been taxed up there, but the leftover money, okay, he's going to use that to invest. And what's right here? Should I just put a dollar sign right there? No, you should not put it right there. Why should I not put it right there? Because what we need here is a question mark. Because there are no guarantees that just because you invest money, you're actually going to make money. In fact, you could lose money because that's what an investment is, right? There's no risk. If there's no risk, there's no reward. There's no upside potential. So right here, the next step is, the unknown, right? Because you don't know. I mean, have you ever heard of a bad investment, right? Of course, people love to talk about their good investments. Oh, I made so much money investing in fill in the blank. Oh yeah, people are a little bit more reserved. Oh yeah, that was a bad investment. Why was it a bad investment? Well, because you lost money on it, and nobody likes to lose money. So that's part of investing, is there is that unknown element. But yes, over here, to get back to the stream of things, if you do make money, okay, well, guess what? That is a capital gain. meaning you use capital back here to invest and you gained on that capital. But once more, where did the capital come from? Well, it came from an income that was already made. So capital gains tax, again, just illustrating a point, I'm not saying this is what it actually is. That's going to be about 10%. So hopefully you see why it would be less than income tax, right? Because two reasons. Reason number one, the money's already been taxed once. So, you're going to tax it. You can make a really good argument that the capital gains tax is a joke in and of itself because the government's already got their money. They've already taxed it once. Now they're coming in to tax it again. I realize you can make both sides of the argument, but that's where I'll give credit where credit's due. At least the government acknowledges, hey, yeah, I know, we've already taxed you once on money, and then you took that money and I won't say the next part, but you made more money on it. So we'll only do it 10%. But the government, again, to their credit, is also saying, and we also understand that you took money that has already been taxed once and you risked it, right? You had some risk in regards to that. It wasn't like a job where there's no risk. You show up, you get your paycheck. There you go. No. You were willing to take some risk. You were willing to make an investment into a fellow company, some sort of investment, which does help, right? Because people need money. And that's what, at the end of the day, if you're investing in the stock market, you are helping a company grow. You are helping a company in various ways. But at the core, the government's saying, okay, yeah, we appreciate you making an investment, taking on risk. So we're not going to tax you as much. And also, yeah, we already know we taxed you once. So that is why it is lower. And that's the difference. And this is also why, if you've ever heard the talking point, it's a very commonly used one, at least at the time of this recording. It's just not right when Warren Buffett's secretary pays a higher tax rate than he does. Now that's very, I was going to say sleazy. It's not sleazy. It is kind of sleazy because it's very misleading. She pays a lower tax, she pays a higher tax rate than Warren Buffett does. But you should now be able to understand why. Well, what tax rate is Warren Buffett's secretary paying? They are talking about income taxes. Where does the vast majority of Warren Buffett, so if you're not familiar, one of the greatest investors of all time. What did I say? Investors, meaning he's risking his money to make money. So his tax rate is based on capital gains, which, yeah, that's why it's lower. It's not because the tax system is rigged. It's not because Warren Buffett is some greedy savage that's somehow manipulating the tax system. No, his money is being generated through a different form. Again, at some point in time, that income was already taxed once. Now he's taking on risk. So he's paying a capital gains tax as opposed to a secretary who's taking no risk because she's just working the job as his secretary, getting the paycheck, and then needing to pay income tax, which is higher. So whenever you see that argument, notice they don't say taxes, because Warren Buffett, even paying a lower tax rate, still pays way more than his secretary. So that's why they need to throw in there the tax rate to make it sound, that's just not right. But I would hope you would say, okay, I can see the difference here. So just keep in mind, when you see that talking point out there, just realize that those people, now that you're educated on the difference, now that you're educated on why it's structured the way it is, just understand that whatever person is making that claim, they think you're an idiot. They are hoping, they are playing on the fact that you don't actually understand how this works. And I would argue those aren't people you want to listen to. If they're making an argument, if they're trying to persuade you in the hopes that you're just stupid and that you don't understand something, little sketchy. So now to be fair, of course not everybody does that, but that is definitely a very big talking point that is always going around out there. The rich pay less. Yeah, less what? They pay less in taxes. No, they don't. If you were to look at dollar for dollar, they're paying a lot. Are they paying lower tax rates? Yeah, that's very possible because of this, which is now hopefully I explained it in an understandable way. So if you have any questions or anything like that, by all means, please leave those down in the comment section. I pride myself in reading comments, replying to them all. So if you do put anything down below, I will read it. If you enjoy these, general, explanation videos, please let me know also in the comment section, or just hit the like button. And then also check out the channel as a whole. I'm not a big fan of asking people to subscribe after watching one video to the channel. But if you like this video, then yeah, definitely go check out other videos. And at that point, if you're still liking what you see, I'd love to have you as a subscriber to the channel. So you're now educated in income tax. versus capital gains tax, and you understand the philosophy and why they are the way they are. First off, thanks so much for watching the entire video. Real quick, before you go, I want to invite you to a live webinar, web class, training, workshop, online event, whatever you want to call it, but it will be me live revealing to you what I've discovered that has allowed me to transform myself from being an employee to being my own boss, including how I had only one losing day out of 73 days in total. I'm going to cover 3 keys that have helped me unlock profitable consistency within the markets. The first key is super weird, but in a productive type of way. The second key is super awesome because it quite literally is wired into our DNA as humans, making it very easy to use. But in a cruel way, this becomes a pitfall for many traders. I'll explain it all though, including how to avoid the pitfall that it creates for some. And yeah, the third key, when you hear it, sounds way too good to be true, but it's not, and I'll show you how it all works. Then at the end, I open it up for a question and answer session that is, again, totally live. Even if you can't make the live session, please still sign up as it will be recorded, and you can go back and watch the replay that I will send you. Click the image on the screen or click the link down in the description box so you can get the date and time and claim your spot, which I should note is limited due to the fact that this truly is a live event. If you have any questions, let me know. If not, I'll be seeing you soon.